figured the best way to start this is to use an index chart of where the market's been since I started in the industry and started this team. So I started with Scotia McLeod in 1998, and we've had a great run, lots of ups, lots of downs, and it's been a very interesting time to be in the investment industry. And it wasn't too long. I was in for a while on my own, and it's much more of a trader's business when you start. Back in 1998, it was all the stocks going up and down, the technology sector going crazy and then falling, planes crashing into buildings, and a lot of very crazy things happened. But the markets always ticked along as normal. And basically, Jeff got a great start to the market as well, joining me in 2008. I think he was in there. I remember we went out to he joined the team. We went out for this huge party because the markets were never been higher and everything was good. And literally the next week, everything fell apart again. So it was a great time for him to start and get his feet wet. So that was when Jeff joined us in 2008. And then after that, things started to pick up a little bit faster. Jeff was completing his CFA at the time and essentially took over the whole management of the portfolio, the daily grind. So it meant I didn't have to get into the office at 5:30 in the morning anymore. Jeff was the one who had to pick up that ball and took over the portfolio management role on the team. A few things happened since then. So then a lot of you will know Colin Posh. He's one of our longer term employees with us. Started with us at Scotia McLeod and came over to National Bank when we moved in 2012. And Colin right now we'll see what he does. He's on a maternity leave, but he's also living in the States. He had a great COVID where he met a nice girl and got married, had a child, and moved to the States. So whether he ever comes back to us is up in the air right now, but he's always welcome. But he was a great part of our team. In 2012, we made a big transition. We moved over from Scotia McLeod to National Bank Financial. A fantastic move for us. We joined forces with an amazing advisor named Peter Fink, and we also inherited Sue Shokar. And Sue is basically the glue that has kept us together and keeps the ship pointing in the right direction ever since 2012, which is fantastic. She's been 30 years in the industry. Yeah, knows everything. It's always one of those great people to see. An interesting story. Sue, my father was a teacher in Burnaby, and it wasn't so long we were into had moved over there and we were chatting with her that they figured out that my father had taught Sue in grade 9 science. So it's a full circle there. In 2017 and 2018, we had a big year. We moved offices in 2018, and when we moved over, we ended up inheriting Jeff Schufelt, who was in our office when we moved in, and we were very, very lucky to have him join our team. And in 2017, that was another large group of the clients probably here today come from Scott Channel. Scott Channel was an advisor with TD for 30 plus years as well, and then chose us to work with as he transitioned into retirement, and we ended up taking care of his group of clients. So it was a very busy but exciting 2017, 2018. Jeff Schufelt, he's one of the portfolio managers on the team, and he is the master of charts. So anyone who wants to know the technical aspects of where the market's going, it's a great conversation, and he sends us a sort of a daily update and very, very interesting concepts and ideas of why stocks are moving and how they're moving and when to buy them and when to run. So it's a good piece and a great member of our team. In 2020, we got two more of the people on the team to join us. Peter Slavkovsky, who's our financial planner, and Angel, who basically holds the fort down and gets everybody their payments, money coming in, opening accounts, that type of thing. So she held down the fort for a couple years on her own there, which was great. And you can see they all joined right as the market was bottoming and going up nicely. Peter has been a great asset to our team. He replaced Brad. Many of you will have worked with Brad Arms, who ended up moving back to Ontario. And Brad was the previous financial planner. And Brad came from a trust and estate planning background. And Peter comes from an accounting background. So it's really neat to see the two perspectives when you're building financial plans for people. All the work has to get done, but it's just a different lens looking at it from Brad's perspective and from Peter's perspective. So it's been neat to watch that happen, and there's lots of different things that we can do. He'll be speaking a bit today. And Angel's again part of our client service, was our client service team on her own for a long time, and it's amazing how much needs to get done during tax season and RSP season and tax-free savings season, and a lot of that work falls right onto Angel. So a lot of you will have chatted with her on the phone over the years. Charlie, our PM, so she joined right at the peak of the market again. So a lot like Jeff, she's come in in that role as the portfolio manager, another portfolio manager, but more of on the trading side. So she's taking care of all the rebalancing. And it's been unbelievable how many rebalances we've done over the past, really since COVID. It's been, usually you say, oh, we're just going to do a quarterly rebalance and everything should tick along nicely. Unfortunately, the markets have been very volatile and things have been changing on a regular basis for much longer than we would have ever had dreamed. So it's been an interesting and wild ride for Charlie since the day she started in the industry as well, or with us. And in 2022, we had Anissa and Rosa both join the team, and that's been so helpful to us. Anissa is a senior wealth associate, so she works with us in terms of making our lives so much easier. She's again, long-term, came from Scotia. We've brought a few people over. Angel is actually from Scotia as well. And so is Anissa. So we've poached a few people from Scotia over the years, but Anissa's been, in the industry quite a long time and has been a godsend for us in terms of making sure that we stay on track and also just being able to help and service clients. Rosa has stepped in to work with Angel, and she's on the client service team. So again, another person you'll talk to on the phone on a regular basis, and happy to help, always happy to help. So just, I think we've put it's been a big movement over the past couple of years, especially. There's been a lot of transition, especially through COVID. Losing Colin, losing Brad was a big changes to our team, and I think what we've put back in place is amazing. I think I'm very happy with our group as it stands, and we're looking forward to growing and building and navigating these markets as we go. So that's the team in terms of when everybody joined and compared to where the markets are. And it's, again, I just want to point that out as, I kind of started at a bit of a peak when you had the tech bubble happening, and Jeff started a bit of a peak in 2008. And Charlie started at a bit of a peak before this most recent crisis, but again, year over year, the markets keep ticking along, and hopefully we'll be able to navigate them as well in the future as we have in the past. Another interesting thing, and we're working really hard on this, and this is our team of resources. So we have a group within National Bank now that is becoming quite a force. So I really we've got a trusted colleague group at National Bank. So I'm getting to know the individual people who have been in place for a while. So whether it's private banking, whether it's commercial banking, whether it's getting your mortgages, there's a whole bunch of different layers that National Bank has to offer. And they've done an extremely good job of handpicking the right people to come in place and allow us to work with them so that we can add that dynamic to our business. It's a big change for us. In the past, you've really had the two silos. You've had us on the investment side and the banks on the banking side, and it's been tough to interlink the two. But we've had some great success and been working with some amazing people in that area. And we've also done a good job of reaching out and finding strategic partners in the community, people that the lawyers, the accountants, the insurance experts. We've kind of found that niche as well, and made sure that if you have any questions or any needs outside of your investments, that's definitely an area where we're able to help on a much tighter level than we were in the past. So hopefully we can help there. And then I'll give you my crystal ball. So this is your crystal ball sitting on the table in front of you, and it's a market overview. I'll let Jeff get into the details of everything, but this is just sort of the thought process that we've been looking at over the basically COVID period to this little bit of a market recession or pullback or whatever we are wanting to call it. 2020 started. You had your COVID bailouts. And since then, it's been new ground for everybody, especially all the governments that have had to deal with everything as they go along. And so there's no set track of what they're doing or what should be done. But I think the governments are doing a really good job around the world of managing the crisis. They tend to tell a little bit of a different story than what they're, in the media, than what's actually happening though. So you had the COVID bailouts, now you have inflation rising, then we have interest rates going up, and why and what's coming in the future? Well, right now they've been saying, inflation's 9% this year. Well, probably not 9%. Because in 2020 they were printing all the money and giving everybody their bailouts, and they were telling us that there was no inflation at that point in time. Well, you saw it. You saw it at the gas pump. You saw it at the food, at the grocery store. You saw inflation in play in 2020, in 2021. So for them to say there was no inflation, well, they had to say it because they were printing money and handing money out. And then now they're simply saying, okay, well, inflation's rising, so we've got to raise interest rates. So they've been pushing interest rates up as significantly as they possibly can. And is it really to stop inflation? I mean, on one level, absolutely, but on another level, not necessarily. It's probably not 9% inflation this year. It was probably 3 and 3 over the past few years. But what they need to do is they need to raise interest rates so that they can cut them again. Because if they raise interest rates, then they're basically going to have a recession or push us down into some sort of a recession. If they want a soft landing, the only way out of that is to lower interest rates. We can't lower interest rates if they're at 1%, so we needed to get them up to a certain level before we could push on and have them come back down. So I think that the governments are probably doing as best job as they can possibly do. The markets have looked at all the information, and You could see it in July when the market started to bounce back up again. You could see it in October when the market started to bounce back up again. They're putting that all into play, and they're looking at it, and I think people know what's going on. Again, it's tough when the media is always sensationalizing everything and trying to say inflation's going to the moon, and then we're going to go into a massive recession. So I think once things settle down, we should have a good bounce back from where we're going, and I do think that the governments have worked as best as they could. So this is the idea behind it. So we're looking at the decline of 2008 here, and simply saying, what if you just stayed the course? Well, if you stayed the course, you've done very well in the future. And then the second line is, what happens if you panic out and you stay on the sidelines for a year before you get back in? Well, that's really quite an expensive way to do it, but you still do pretty good. And then, of course, what if you just, on the bottom line there, jumped out of the market, stayed in GICs, and never went back into the market? And that's pretty costly. So hopefully this is we're able to keep you confident, calm enough, and on track to stay in the market, get through this bit of a beating that we're taking in the markets today, and we'll be bouncing back in the right direction as quickly as the markets let us. So with that, I will pass this over to Peter, who is our financial planner, and that's one of the main reasons why he comes up next, is because when you're looking at markets like this and you're looking at declines in the markets, the best way to stay on track is to know that your plan is in place. Know that you're keeping up with what you expected, and that the market variations aren't going to put you in the poorhouse. And having a written financial plan is definitely the best way to do that. We've done it with a lot of our clients, and we still need to do it with a lot more of our clients. And I think that, as Peter will walk you through some of the steps, I think this is an interesting and excellent way to make sure you stay on track through your investment career. Peter.
Thank you very much, Brad. That was a great intro. Oh, 1 second. So I want all of you to know that you are just one phone call away from having an answer to your financial questions. Because when Brad started 24 years ago in the industry, you were mostly calling him and asking for advice, where to invest, where should I invest my money, what company should I invest in? And then you were asking him to realize the trade. It was mostly about doing brokerage, right? But since then, the investment world has evolved into wealth management world. And portfolio management is still a huge part of that, but we can help you with all these things. We can help you with financial management, we can help you with tax planning, we can help you with investment planning, with risk management, and even estate planning. Just to give you a brief example, just recently we were working with a client, and we discovered there is a significant opportunity to save in taxes. For the other one, you might relate even more. Just by having an estate plan in place, you can save or pass your wealth significantly bigger to your kids or beneficiaries. I want you to take a look at this chart. Do you feel confident that you have a plan in each of those small boxes? You might think that, yes, I have that financial plan in place, that 100-page long document, that it has all the different numbers, that is hard to understand. But it's not only about that. Your financial plan consists of many small plans and a lot of moving parts as well. So we can help you with cash flow management, with all these things, and we want you to have that all continuously updated. So if you don't feel confident that you have a plan in all these areas, then it's time to make that phone call, really, because we are here for you to help you and have a plan in all these areas. Now let's take it really practical. So on an x-axis, you can see the age. Those are the things that every single person is going through their life. And I'm really sure that you probably know where you are at on this trajectory. But we are here for all of you to help you. So when you start your financial life, we want you to be aware about all the investment principles and have your budget prepared, have your first financial plan prepared. And as your wealth goes up, we also work with you and make sure that your TFSA is maximized. Do you know how many people in Canada have a TFSA open? It's just 40% of Canadians. And how many Canadians have a maximized TFSA? Just 4% of Canadians have a maximized TFSA. So if you're one, pretty sure that many of you in this room have a maximized TFSA, you're one of those 4%. We want you to have your RSP used wisely and efficiently. And we also encourage all the parents to use all the advantages of RESP account and start saving for their kids' education. Let's be fair, all the free money from government are great, right? So as you move along and your income starts raising or going up, we are working with you closely as well, and we want you to understand all the tax-efficient income strategies, so you are not leaving anything behind or leaving anything on the table. And we are working closely with all our colleagues at National Bank, making sure that your financing needs are also fulfilled and you're getting best deal out there. And insurance-wise, all of you in the room have a different insurance needs. So when you start in your life, you might be just looking for protection for yourself and your family. That's why you go after term life insurance, or maybe have a critical illness or disability insurance. But as you move along and you get into the middle age, it might become your wealth management tool. And even further on in your estate planning, it can become your tool for estate planning. And you can save quite a bit of taxes there. And once you get at that point, when you start thinking, enough, I want to retire, that's when we sit together and we put a plan, detailed plan in place, so you're not missing anything and you are transferring smoothly into your retirement. And while we are doing that, there's also, we will open the estate planning box with you. We want you to have your will prepared and updated. We want you to have your power of attorneys in place. And if you are a power of attorney, do you know what responsibility you have to be a power of attorney to someone? We can help you with that as well. And lastly, your legacy. Are you thinking about what are you going to do with your legacy or with your wealth? Those are, I found it once I'm preparing the financial plans, like people don't think enough what they're going to do with their wealth. Do you want to spend it all during your retirement years, or do you just want to pass the wealth to kids while you are alive and see how they are enjoying the wealth that you build up over your lifetime? Or you just want to leave it for your estate and have the kids use it after you're gone? So these are all the things that we can help you with. And make a note where you are at or what area you want help us. And please let us know. Because if you won't let us know, we won't know that you need help in it. And you see yourself in the center of this chart. Because it's 100% about you, but only you. But not only. Because you are part of a bigger system there. We know that you truly and deeply care about your parents. You care about your children, hopefully. And maybe even grandchildren. Maybe you care about your friends or extended family. So we build this incredible big team to help you, but all those people around you, because if you want you to be successful and all the close ones as well. So next time when you are talking to them, just ask them, do you have a financial plan in place or do you have an investment plan? Because we're here to help all of you. all of those people. So as I said at the start, the investment world has evolved into wealth management world. And while like 15 years ago, you were sending emails to Brad and Jeff asking what company should I buy, Apple at $1 back 20 years ago, we are still getting a lot of those questions. But our mailbox is full with other questions that are more related to wealth management planning. So we are getting questions like, can I retire next year? Or should I start taking my CPP? Or when should I start taking my money from the RSP? Or very, very popular one these days, should I pay off my line of credit with the investments? Or are there any strategies that I overlooked? So those are all the questions that we are answering daily to all of our clients. So don't think that we are just here to manage your portfolio, which we are 100%, but we can answer many other questions that you might be asking, but you are just not asking them. So if there's only one thing I want you to take away from my part today, just remember that we are here for all of you. And if you have any question, or if you think that there is a gap in your plan, just let us know, and we'll definitely start working on it. So with that said, I would like to turn it over to the man that probably everyone is waiting in this room, because he has the crystal ball, our managing partner and portfolio manager, Jeff Rivett.
Thank you.
Over to you, Jeff.
All right, thank you, Peter. I think I got it on here. Oh, I do need that, yeah, thank you. So, I mean, I think I definitely drew the short straw because Brett got to talk about the team and brag about everybody who's here to help you. Peter gets to talk about all of our services, and I have to talk about the market this year. So I'll do my best in typical fashion. You know, I'm always prepared. So I hope that you find this informative and worth coming out tonight for. And I'll try to see if I can figure out how to work this remote here. So, you know, just recapping, when we were talking as a team about having this AGM, and it's the first time we've done this. I mean, obviously we've had a 3-year period where none of us have been able to do this, and so all the opportunities to be able to get together and have events like this, I think, are worth doing. But really what we wanted to do is for clients who've been with us for, you know, a lot of you for a long time, there's sort of 3 main objectives. One was, you know, getting to meet everybody. You know, you see all these names by email that come through, you get calls on the phone from folks, you see names on your statement. But, you know, our team is more than just a financial bank. You know, these are people that are genuinely working every day dedicated to your money. And I think it's really good for, hopefully, you leave here understanding, putting faces to the names that you see, and really feeling comfortable with the group of people that you have behind you. The second thing, as Peter alluded to, is, you know, we really have evolved into the place that people call for everything. And I expect that will continue for quite some time through my career. And as Brett mentioned, it's definitely changed our role from being purely investment and portfolio managers to now folks calling us, and everything from retirement planning, like Peter said, or questions like, you know, how do I ensure my future son-in-law doesn't run off with all my money, or anything like that. And you know, we've learned a lot, and we continue to learn, but we really want you to leave here feeling like that you can call us for anything, because we're here for that. And lastly, my part is just, you know, you put a lot of trust in us. Many people in this room have been clients for decades. And I really want you to leave here, especially in a year like this, feeling like you've got the right team managing your money, and that confidence and that trust in us is well deserved. So just brief the overview on the portfolio management side. I want to talk about, you know, the major challenges this year, and obviously there's been quite a few. I think everyone would like to know, you know, what we've been doing and how we've been managing your money, and also what we expect in the year ahead. And so I want to talk both about, you know, I've got lots of charts, and we'll talk about, you know, we'll go through the charts. But I also really wanted to use this opportunity to showcase what it is as a team that we do every day. I think for new clients who get the opportunity to sit down with us and we do a proposal for, we talk about our process, we talk about our strategy. But for many people in the room who've been clients for a long time, you probably don't actually know exactly what we do every day. So I wanted to go over that a bit as well. But to start off, this has been 2022. So it's been one of the most challenging. It's been one of the most challenging years of my career for sure. And like Brett said, I started in 2008, so that's saying something. But we've been through a lot. We started the year off with inflation that we hadn't seen since the 1980s, and that problem continues today. We had the unfortunate invasion of the Ukraine, and that problem continues today. We had interest rates rising, and that problem continues today. And we had supply chain constraints. Everyone rushed out to spend their money after COVID, and there wasn't enough stuff to buy, and that's been a major issue, and it is getting a bit better, but it's still an issue. We've had a lot of problems in Asia. I mean, China is the largest, second largest economy in the world, but the fastest growing or largest contributor to economic growth in the world, and they've had a challenging year with their policy of basically zero tolerance for COVID. And probably the most recent challenge, and the one that's probably most pressing, is, are we going to have a recession? And that's been an ongoing fear for probably the last 4 or 5 months, and what that means. But I think that really the major cause of this has been interest rates. And I think I really love this chart. This is a lot of things going on, but this is every time the Federal Reserve in the U.S. has raised rates. And so there's a lot of different colors there. This goes back to 1970. So it's 50 years of the Federal Reserve doing its thing and raising interest rates. And the dark red one is the current cycle. And it's important because what it shows is that this is the fastest rate hike cycle in modern Federal Reserve history. Meaning that, yes, they've gone further and gone higher, but the speed at which interest rates have been raised is the fastest ever in modern history of the Federal Reserve. And that's had a massive impact. And one of the reasons that this year has been so challenging is that has impacted the bond market in a way that again has never been seen before. So this is a chart showing U.S. bond returns, and number one, we've had the U.S. has done worse than Canada, thankfully, but the average government bond in the U.S. is down 21% this year, and that's incredible. Like, you look at the 1980s, during when we had 15% interest rates and runaway inflation, and bonds did better than they did this year. And for us as portfolio managers, we're trying to balance risk all the time. And so, typically, stock markets go up and down, and we understand that, and I think investors understand that. But when you have a year like this, where your safe money also goes down, it becomes a real challenge, because there's essentially been nowhere to hide. Outside of oil and commodities, cash has not lost money, and there's been some areas like the TSX in Canada has done a bit better than other markets in the world, and other commodities like central countries in Latin America have done a bit better. But generally speaking, if you had 100% of your money invested in bonds, in Canadian bonds this year, you still lost 14%. And again, so it's just a year that's really been a challenge to just try to avoid all of these landmines that are at the bottom here. And that's really been our major focus. So I thought that in sort of talking about all the stuff that we've been through, I just wanted to sort of pause and talk a bit about what our process is. So this is all well and good, all this stuff's going on, but what do we actually do? as a portfolio management team. So I think, I love this picture because I kind of feel like you guys think this is what I look like. Like when you envision Jeff at work, he's got 6 screens in front of him, he's got his hands on his head, and like clearly there's been some days this year that that's exactly what I look like, no doubt. But generally speaking, you know, we have a process that we follow in place. And I just wanted to sort of go over that a bit with you and just briefly talk about what it is we do on a daily basis in going through markets like this. So first off, we follow all the stocks that we own in our models. We follow them every day, as you'd expect. We look at all the news flow that's happening in the companies. We look at it, we rank them from the best performing to the worst performing and analyze why that's happening. And we look at what's happening in the world and the impact on those investments. And we chat as a portfolio management team. We're in constant communication if there's anything that needs to be done. We also monitor all the investments that we own, both before the market, the pre-market, and after. And so for myself, when I wake up in the morning, my phone alarm goes off, I hit the snooze button, now I turn it off, and then I flip open my trading app, I look at what's been happening in Asia and Europe the night before, I look at what's happening in the pre-markets, so I know what kind of day I'm going to have. And then after the day is done, sometimes we have companies that report earnings, and we're following along and looking at what's happening after the market's closed so we know we can prepare for the next day if there's anything that we need to do. And then on a weekly basis, as a portfolio management team, we have a dedicated time. We sit down every Monday, we talk about all the positions that we own, we look at their relative performance, we look at how we're doing compared to the benchmarks to make sure that we're doing our job and doing better than the benchmarks. That's the reason you hire us. And also talk about strategy, about the companies that we own. What do we expect that's going to be coming down this week? And if and when certain things happen, how are we going to prepare for that? What moves are we going to make? So we sit down every week and do that. We're very fortunate at National Bank. We have a great team of resources, and Brett mentioned from the bank side, but also National Bank has an absolutely fantastic research group. And I'll talk a bit more about that after. But every month we go through, we get recommendations on asset allocation, which is basically telling us where in the world our team at National Bank thinks we should be invested. And we review that monthly. Quarterly, we do rebalance, so we ensure that our investments are in line with where we want to be positioned. And we also look at all the companies we own every quarter. They come with earnings. They talk about where their businesses are heading, and we read those. Not only do we read all those reports and analyze what's happening, but we also know that the earnings days are coming up, and we prepare for them and watch as they come out and see if the expectations that we have match with the actual results. A couple more things. We have some third-party managers that we have some both in our bond funds. And especially with like international investments in emerging markets, we have third-party managers because I'm not going to pick stocks in Asia. So we have third-party managers that do that, and we basically look at what they're doing every quarter and ensure that they're doing their job. And then lastly, we do around this time of year, especially, we do a lot of tax planning. If we have an opportunity to reduce your tax bill by bringing down capital gains or moving investments around in a way that makes them more tax optimally. You don't necessarily see that in your investment returns, but we do look at that every year to ensure that we're optimizing your taxes. Just briefly on sort of the team that we have behind us. So Stefan Marion is our chief economist. He's ranked top 20 in the world, which is not a small thing for an economist, and he's one of the top in Canada. He's as far as predicting the future goes, he does a better job than me. And so, every month we're fortunate that he puts out research, he puts out suggestions saying, here's how we think that you should have your clients' money invested. We should have this much in this country and this much in the US and this much in bonds and what have you. And generally speaking, we follow his recommendations pretty closely because that's his job and he's good at it. We also are fortunate to have a chief investment officer who oversees about 30 analysts in Canada. We have access to them if we have any questions on any of the companies we own in Canada. They're there and they're available, and they put out research to us daily, weekly, monthly reports on what's happening, trends in Canada. And we have third-party researchers for the U.S. and internationally as well that we draw on. So with regards to this year, and sort of our approach to managing your money, taking into account all the processes that I just went through that we have, and the resources that we have, and talking about what the year's been, I just thought I'd sort of go through an overview of really what our approach has been and what our approach is going forward. So first off, we aren't panicking, and I think that goes without saying. But we aren't panicking because we believe that the stock market not only has it been one of the greatest creators of wealth for generations, but we believe that it will continue to be. And I really love this chart. This shows, it's a couple years out of date, but it basically shows 200 years of stock market returns in the US. And the big green bar down the middle with the 47, that means 47 years, so the majority of the years, the US stock market has returned between 0 and 10%. What I also really like about it is you look at the first 3 green bars and you add those all together, it means that over half the time over the last 200 years, and over half those years, the stock market's returned between 0 and 30%. So again, a very, very positive, reinforcing chart to look at. But also when you take into account this year, the US market improved a little bit in the last few weeks, but we're still sitting around 20%, which puts it basically down near that third smallest red bar, where there's been 6 years of the last 200 where we've seen this kind of return. So again, it tells us that what we're going through is not normal, and we believe that this trend will continue for the next 100 years, just like it has for the past 200. So we're not panicking, and we believe that the stock market will continue to provide us with great returns. Second is, we recognize the opportunity in moments like this, and the opportunity comes because human beings, we're not always rational, and we're emotional. And especially when we get scared, we fight, flight, or we freeze. And it's no different in the investment market. And because of that, we're afforded opportunity because people do irrational things. And this chart here, which I really like, basically shows the last 7 market corrections, which is my career, Brett's career, probably most of you guys' investing lives, going back to 1987. So this is what you've been through. And I love this chart because it shows 2 things. One, it shows there's obviously major overreactions in both ways, both up and down. But it also shows that there's massive opportunities that come in these moments where we have these pullbacks, where we typically see that the largest gain. The yellow bar is 12 months after basically the bottom. And I don't know if we're at the bottom yet. I certainly hope we are. And this particular this year will be on this chart, I guarantee you, in the future edition. But it shows just how people tend to overreact. And seeing something like a 33.8% market pullback in the US during COVID, what that effectively means is, if you put that in dollars, that's like $30 trillion or so of market cap across, and this is the US, but across the world. It was wiped out because of COVID. And yes, COVID was awful, and it was never seen before, and it was a major world event. But $30 trillion, it was obviously an overreaction. The economy didn't contract nearly that much, but yet the market feared it. And you know, we've seen similar things like that before. And then vice versa, you know, having a 78% spike up from that, you know, part of that was recovering from the hole we were in, but also it's for us, we're looking at the opportunity. There's opportunity on the downside. And there's also opportunity when we get these periods where the market has these massive runs up. You know, we want to make sure that we're positioned properly to be able to also lighten up. And we successfully did that before COVID, after we had a pretty big run up in 2018, 2019. And we did this year too. I mean, this year we would have been nice to have more cash and more safe assets. But you know, we came into the year looking at this and saying, yeah, like things went up really fast. And so, you know, we were well positioned to really to enter this year and not take the full brunt of what many investors have. And because of that, we've had above average returns. The third thing, and this kind of connects with this idea of opportunities, we are buying low. And this is a list of companies we bought in our model portfolios. So this is in our model portfolios, fully managed over the past 6 months. And so I guess a couple things. These are companies we've either bought as new additions or companies that we've added to. And you know, the column on the right, which I wish was a little bit bigger, it's probably hard to read the back of the room, but it basically shows the discount that those companies were at when we bought them. And there's some on here like TD Bank, which we bought when it was down 13. Now it's down about 26. So sometimes it doesn't work. But then there's companies like Starbucks and Costco and CN Rail and that have come back. And I think I show you this because when you have markets like this, there's a real opportunity to buy what arguably are some of the best companies in the world. Certainly, you know, like Apple and Amazon, Disney, Microsoft. You know, that we have the opportunity to buy these at these discounts. This isn't something that you always get. You know, last year, if you wanted to buy these companies, you had to pay near an all-time high price. And if you wanted to buy something at a discount, you had to buy a company that was maybe, you know, had some warts, had some things wrong with it. And so we've had a really unique situation this year where we've been able to really improve the quality of the companies that we own and add more to the companies that we love. And so you know, we continue to buy low. We continue to be prepared to do that. And if the market continues to go down, you know, we'll certainly continue to be able to add to these. Fourth is that even though we're very optimistic, we don't know what the future is going to bring. And as risk managers, as soon as we think we know what's going to happen, that's dangerous, right? Our goal is to ensure that we're not taking any major risk in any one area, so that there's never any one single thing that can really rock us. And so we're always preparing for the worst. And I guess right now, you know, recession is arguably the sort of the worst thing, or what folks are worried about. And the reason that recession's become such a hot topic, I guess, is because, you know, typically when you see interest rates spike up like they have, and this is sort of 60 years of what's called a yield curve inversion, which essentially means short-term rates rising really fast. And what we've seen with all these other previous spikes where we've seen short-term rates rising really fast is every time we've had a spike up, there's a gray bar that follows, and that's a recession. And so when we see this current spike that we're at, market prognosticators look and say, yep, it looks like we're going to have a recession because we always had before, and that happened. And that very well might be the case. The other reason that I think could likely have a recession is because recessions are self-fulfilling prophecies. I've said this to many of you before, and that when people think there's going to be a recession, they stop spending money, and they stop hiring, and then we have a recession. So, you know, we are preparing for the worst case scenario as well. And looking at this, again, this is sort of our fully managed balanced portfolio. So, you know, a client comes in today and says, I've got cash. What would you invest it in? This is sort of where we're sitting at right now. And a couple of things to point out. Number one, if you look at Canadian, US, international equity, we're roughly around 60%. And that's not overly aggressive in equity. It's not cautious in equity. It's kind of average. But as I said before, the quality of that equity, the quality of the holdings that we now own is much, much better than probably it's ever been. Secondly, the gray piece at the top is gold. We love gold. If we do have a recession, especially if we have a recession with inflation, which is not a good thing, but if we do, then gold is really one of the only things that is surefire, will be a surefire success. So we continue to own gold and may add some more. We have quite a bit of cash right now, and that's sort of accumulated from dividends, interest, and also from, again, as we sort of improve the quality of the portfolio, we've exited some positions that are more risky. And cash is actually pretty good right now. Cash is paying about 3.5%. So it's not like before where cash was just kind of dead money. It's paying a decent amount right now. And when you look at the yellow, the 31% or so that we have in fixed income, that's also vastly improved. So if we looked at last year, we really had to stretch into some higher risk fixed income, into preferred shares, into high yield bonds to get a decent return. Now almost all of that is all government of Canada, government of US, high quality corporate bonds that are paying us 4 to 5%. And if we do have a recession, and again, typically during a recession, we see interest rates fall. These bonds that we now own, this fixed income that's paying us 4 to 5%, these are the same bonds 11 months ago were paying 1. And so if we do see rates fall and come back, really the best investment, or if we do see a recession and we do see rates fall because of that, really the best investment we could own is high quality fixed income. So we've continued to fix that part of the portfolio as well. Now, with regards to sort of we are prepared for the worst. We are prepared for a recession. We're prepared for what could happen. But we're also really optimistic about what this year brings, and that's for a few reasons. Number one is that, as Brett mentioned, inflation's gotten a lot better. And this chart, the blue and the red, the blue is the U.S. number, the red is the Canadian number. So we see U.S. inflation's around 8%, Canadian's around 7%. The bigger numbers are year over year, meaning that what are prices this October? This is an October chart versus last October. And that is starting to stabilize, which is a positive. But more importantly, the bottom numbers are annualized inflation over a 3-month period. So that doesn't mean that this is 3 months worth of inflation and you're going to go 2.4 times 4 is 10. It means that over the last 3 months, when you're looking at October compared to August, in Canada, we've only seen inflation go up by about 0.6%. And in the US, it's by even less, by about 0.5. So we're seeing inflation finally flatline out. It's not declining yet. We're not seeing deflation, but we're seeing prices start to stabilize. And this is a huge positive for a market that's really been driven by inflation fears. And one of the effects of this is that we also expect that interest rates are finally nearing a peak. And for the lenders and bankers in the room, this is a really important chart. And if you have a variable mortgage coming up or anything like that, also a very important chart. But this comes from our National Bank economic team. And essentially what it shows is that the red line again is Canada. And it's showing that from where we stand right now, we see another 25 basis points or 0.25%. So one more interest rate hike in Canada before the end of the year. And then we expect it to sort of stay flat and sort of see what happens. And in the US, this chart's a couple of weeks old, but the anticipation was we'd have a 0.75% increase, which we had, and that there'd be another 0.5 by the end of the year, which we expect. And again, the same thing, that rates will sort of stay there and see what happens. And again, as inflation starts to decline and the economy starts to slow a bit from these higher rates, we expect that rates will come down. And so again, another major positive. If this starts to happen, this would be a would be a huge catalyst, obviously, for the market, and could totally change the trajectory we've been on. Another positive is the labor market's really strong, and I guess it's good and bad. It's bad if you're trying to hire people, but from an economic perspective, unemployment, which is the blue line in the U.S., is again almost as low as it's ever been, despite all the economic trouble that we've seemingly been having. And the red number shows how many job openings there are per unemployed person in the U.S., which is, thankfully, it's in year 2, meaning that there's basically two job openings per unemployed person, which is why it's hard to find people. But also that number is starting to come down a little bit, which is good. It means that that things are softening a bit. It means that the demand for, hopefully the demand for labor comes down a bit, meaning that there'll be a bit of relief from wage inflation as well. And then if we do have a recession, I think these charts are really neat. This is a lot going on, but I'll just basically, this is every recession since the Depression. The Depression's on here. The bottom one's the Depression, 1929. So this is every recession, depression that we've been through in the last 100 years. And what you have is the starting point is when the recession begins, and then 2 years later. And so, what we see is that out of the 15 recessions we've had, 4 of them have resulted in a negative return for investors over 2 years. But 11 of them have been okay, and some of them have been great. And I think really, really interesting too is that when you look at the 4 that have been bad, 2 of them happened during the Depression, and 2 of them happened in the last 2 decades. One is the 2001 stock bubble in tech, and one is the 2007-2008 Great Financial Crisis. So excluding those 4, every other recession we've had in the last 100 years has actually not been the catastrophe that maybe we expect. And I think that there's a bit of recency bias because we've experienced these 2001, 2007 recessions, and sort of that's left this idea in our mind that recessions are a terrible thing for investors. And then sort of lastly on the recession part, again, a lot going on this slide, and I'm sure we'll send these out after, have copies. But essentially the first column, again, is showing every recession going back to 1953. And what we see is that the returns during a recession, which is the first column of blue colors, the returns during a recession are actually not that bad, usually. On average, we have some recessions that have been positive during them, some that have been negative. 2007, 2008 was obviously very negative, but generally speaking, on average, the market during recessions has been essentially flat. And it's the 6 months and the 12 months before the recessions that typically we see the worst markets, and that's where we think we are now. That's what we think we've been through this year, is the 6 months and 12 months leading up to the recession, if we were to have one in 2023, that we've been through. And when we look at the 6 months after, 12 months, 2 years after, the numbers just get better and better. So again, just sort of summarizing, hopefully, what we've been through, where we see the market going, and looking at, that we aren't panicking. We believe that the stock market will continue to be a great deliverer of wealth like it has been for the last 200 years. We think that there's opportunity in human beings being emotional and investors being emotional. We're taking advantage of the opportunities that are in the portfolio, that are out there to buy higher quality companies at discounts. We're preparing for the worst by having things like cash and bonds and gold on hand and improving the quality of the equities we own. But we're also really optimistic about what's coming. And the last slide, I just wanted to sort of finish up, and I guess finish up this AGM as well, before we have question and answers, just sort of talking a bit about our team and why I'm really proud of this team that we have. We've won 3 awards of excellence from National Bank over the last 5 years, 2 for Team of the Year and 1 for Portfolio Management. But when I look at what we've done, we have over 10 years of above average investment returns. Between Brett and myself, we've been through 5 of those major market sell-offs and come out the other side okay. We have an annual client retention rate of 98%. So generally speaking, clients don't leave us, and usually when they do, it's because they pass away. But we have the clients that tend to be with us stick with us, and we really appreciate that. We really appreciate the trust that you put in us, and I think that's partly because we our process and our portfolio management, but it's also our client service, and that, it's really important to me that our clients stick with us because they believe that they're being well served. And just lastly, I mean, our business, this isn't a pitch for you to refer all your friends, but if you want to, sure. But our business truly is almost entirely, almost all of our growth comes from referrals. We don't really do a lot of outside marketing. We don't have fancy Facebook campaigns. The majority of our business comes from people like you, and we really appreciate that. And I just want to thank you very much for continuing to refer family and friends to us. And when I started with Brett in 2008, the two of us, we managed about $50 million. And today, I mean, we managed a bit more at the beginning of the year, but we're near 500 million. And that's largely come from referrals and clients just trusting us with more of their money, trusting us with their family's money. And I just really want to say thank you to you all for being here tonight, and thank you everyone for continuing to put your trust in us. Thank you. So, is this on? Okay, I'm really tall, so I'm gonna have to crouch to answer this question without a microphone. So the best way I can explain it is that if you go to the bank and thank you, is this, okay, that's better. That's way better. Chiropractor and Superman. If you go to the bank and you buy a GIC, last year if you bought say a 5-year GIC, so you locked in your money with the bank guaranteed for 5 years, you would have got about 1.5% interest, and you would have been stuck with that GIC for 5 years. Now this year, interest rates have gone up, and so if you walk into the bank and you wanted to buy a 5-year GIC today, you get probably 5.5%. So what would happen, now you own a GIC that pays 1.5%, you're stuck in it. Say you could sell it to somebody. If I could go to the bank and buy a GIC that paid 5%, or I could buy yours that pays 1.5%, I'm going to give you a lot less for yours that pays 1.5%. And bonds kind of work the same way, where if you're buying a 10, 20, 30-year bond, you're locking in for a long time. And so especially when rates were so low, when you have rates go up as fast as they have, now you're trying to sell a bond that's guaranteeing 2% for 30 years. And if I can get one that pays 4.5%, I'm going to give you a lot less for your one that pays 2% for 30 years. Does that answer your question? So national banks, chief economist Stefan Marion, superstar, believes that we will start to see rates decline in the third quarter of 2023. So that we're expecting that they will, in Canada. In the US, the US is a bit longer, so later in the year. But in Canada, the expectation is that interest rates will go up by 25 more basis points before the end of the year, stay flat for 6-9 months, and then we could start to see declines. I'd have to flip back to the slide to see the exact number because I don't know it off by heart. But I mean, yeah, we expect to see declines of about 1.5% down, so that'd be close to 3%. Yeah. And when you look at sort of the neutral rate, or what the long-term rate is, it's around 3%. So we'd want to get back to that neutral rate. And as Brett was kind of alluding to, part of the reason that that central banks want to raise rates is to sort of build up that war chest to be able to bring them back down again to stimulate the economy when they need to next time around. And again, that's where you see that sort of 3% as sort of that neutral rate. No problem. I'll go with my bent over mic here again. Maybe I can, there we go. So thank you for that question. So what Stephen's referring to is that when we have gains from selling stocks during a year, that's a capital gain. And when you do your taxes, you have to pay tax on that gain. And thankfully it's still a pretty low tax. We'll see if it goes higher. Right now it's still pretty low. But generally speaking, what we do, our actual process is, we actually go through every single taxable account in November, and we literally create a spreadsheet of every single account we have and what the current gain position is, and then we will go through each account individually. Thank you, Charlie, and look for where there's opportunities to reduce those gains. Now, there's some situations where you may sell a property, or you may have gains that exist outside of our world where we don't see them. And if that's the case, then certainly it would be great to communicate and let us know about that. And that comes through financial planning. It comes through correspondence of knowing, what individual people need. And the idea of selling things at a loss, in some ways it makes no sense, but there's often a lot of times that we can switch in between investments. For instance, we could sell shares of one Canadian bank that are at a loss and buy shares of another Canadian bank, and kind of keep our exposure the same, but reduce your tax bill. And so we look to do that as well. So I kind of think, weird microphone. I kind of think that I think that cryptocurrencies are here to stay, and I think when you look at things like Bitcoin, Ethereum, some of the bigger ones, I kind of feel like it's like the Amazons and the Apples and the Googles of 2099, in that everything's going to get completely beaten up, and there'll be a few that survive. I think that right now, when you look at the price of Bitcoin, it's roughly trading for the price of its mining costs, and I won't get totally into that right now, but it's essentially fairly priced, I guess, if you were to do an evaluation of it, compared to the cost of actually creating it. And before, it was just trading on just pure hope, I guess, and people's optimism. We don't really have any cryptocurrency exposure in our portfolios. National Bank's pretty strict, thankfully, with that. Not that I'd really get in there. I have some in my kids' education savings plan, and I've lost them a few $1,000s. Don't tell them. But yeah, it's not something we invest in as a group. I think that it has a benefit in that when we're trying to diversify and we're trying to minimize risk, I think the more asset classes you can have, the better off you are. And I think that any reasonable investment that can increase your diversification is a good one. But it's not really something that we're actively getting into, and honestly it's not something that we have a lot of demand from in the conversations that I have with clients. That's a really good question. So like buying low is really easy, because pretty much anytime you buy a blue chip mega billion-dollar company at a discount, you've always made the right choice, and that it always goes up. I mean, I guess there's like General Motors and a few that haven't, but generally speaking, when you buy big companies at a big discount, it works out. Selling high is really hard, because when you sell a company, chances are pretty good that it's going to be higher somewhere down the line, and you're going to look back, and we do. We have a spreadsheet of every company we've sold, and we follow it, and we mercilessly punish ourselves when we make mistakes, so that we know where we made mistakes, so we learn from them. So selling high is really, really tough. you know, we sometimes what happens is there's companies that we just get kind of frustrated with that maybe have potential opportunities for tax planning, that we worry about that their survival through a tough period like a recession. And so we would look at opportunities like we had in June when we had a big market spike up, or an opportunity like we have now in October, or we had last October where we had a spike up. And when we get a 20–30% move up in that company, we might look at exiting it. But generally speaking, it's more about when you're exiting a company, it's more about what you're doing with that money. So if I'm selling shares of Starbucks as an example, you know, what is it that I'm now doing with that cash? Am I just sitting it in cash and hoping that Starbucks stock completely collapses? Or am I moving into a different company? And if I'm doing that, then I want to make sure that we track ourselves to make sure that those decisions are good decisions. I mean, and ultimately we make some bad decisions. There's lots of things that I wish I could have back. But generally speaking, you know, there's enough, certainly more than half, where we look and say, okay, we got out of that company, we went into this company. You know, company A went up 10%, company B that we bought went up 30. You know, and that's a win. As far as finding companies to buy, it's a bit of a mix. So, you know, we can do just pure fundamental analysis where we set up screens and say, you know, I want to see every company that's got bigger than a $10 billion market cap, that pays a dividend, that's paid a dividend for 10 years, that has, you know, low debt, that has a lot of insiders that hold it. You know, you can set up any metrics you want, and we have screeners that will spit out a list of companies. And with investing, I would say that, like talking about human emotion, investing is 50% fundamental and 50% emotional, meaning that as a CFA charter holder, we can do all the analysis in the world and come up with, you know, this is the company you should buy because all the valuation metrics say so. But if everyone hates the company, it's not going to go anywhere, right? So it's a mix of both, and it becomes you know, for me, I think, because I've been in the industry for 15 years and I don't follow every company, but we've owned hundreds, and so I have a list of companies that we follow, that I'm comfortable with, that I kind of know how they behave. And so oftentimes we'll sell a company and we'll buy the same company back later on when it's fallen down because it's on our list. And then of course we have our whole team at National Bank, which supplies us with buy lists of companies that they recommend, and quite often we'll follow those as well.